All right, let's break down this whole beast that is capital gains in plain English. Think of the profit you make when your property goes up in value and what you bought it for. We call that the basis. So, say you bought something at $500,000 and you sell it for $750,000. Boom, you've got a $250,000 capital gain. Good job. But you got to pay taxes on that capital gain, that increase. Pretty straightforward, right? Now, the first nuance that we want to talk about is short term versus long term gains. Short term gains get taxed like your regular income, anywhere from 0 to 37%, depends what Congress does in the future. Yikes. But if you hang on to your property just over a year, congrats, you've hit this long term gain territory. Taxes drop 10%, 15%, 20%. Much better, right? I would also add in there that not all CPAs see it this way, but based on the case law and what the IRS tax codes say, it's pretty much adopted that this 1 year threshold is what triggers this. But again, this is what separates CPAs on a threshold between more conservative and more aggressive, or what the actual law says. So, in addition to capital gains, you have this other thing called depreciation recapture, which is a little sneaky here. And it's a little bit more tricky. Now, when you sell, the taxman wants the piece of the depreciation you claimed previously, and there are two flavors. There's the straight line and appreciated bonus depreciation if you took that. Now, without going full CPA mode on you folks, because that's not the level that we want to get to here. We want to just stay high level and we want to learn this from being an owner's point of view so we can have the educated conversations with our CPA. But just know about how fast you claim that depreciation and how it happens when you sell. So, use an example here. My first property that I bought back in 2009 was about $350,000 in Seattle, Washington. Now, Seattle is one of those areas where the price of the land is a lot more in comparison to the value of the property. We've got some properties in Texas and Alabama where the percent split between the land portion and the property improvement portion has actually flip-flop. To just use that Seattle example, 150 to $200,000 was the improvement value of the property, where the rest of it, of the 350, was the land portion. So I was able to take that improvement portion divided by 27 years and take that depreciation every single year, which came out to be about $6,000 per year, which more than knocked out the income that I made from that rental property. But as I'm saying here, when you sell this thing, you got to pay all that stuff back. This is the old depreciation recapture. So depreciation is a double-edged sword here. It can slice your tax bill when you're going through the hold, but this is where it stings you at the end. And this is why I always say, like, when people are looking at getting cost segregations out there, if you're going to sell the property in 4 to 6 years or less, it may not make sense to spend the money on the cost segregation because you're going to get hit on the depreciation recapture. But in most cases, the golden rule, a dollar saved today beats a dollar tomorrow, because you can take that dollar saved today and invest it, and ideally, maybe that dollar becomes $2 in 5 years. Essentially, depreciation that you reinvest the savings that you got from the taxes today for bigger wins down the road. But let's tackle the elephant in the room. Right now, you're selling an asset, and how do we soften that blow from the capital gains and this sneaky depreciation recapture from selling?